Welcome to the Explainer. Today, we're jumping into the deep end of professional scalping. And look, let's forget the whole high-risk Hollywood gambling stereotype. We're going to break down exactly how the pros turn this incredibly fast-paced trading style into a disciplined, rule-based business.
And this quote just hits the nail on the head, doesn't it? The real difference between making it and breaking it has nothing to do with some magic indicator. It's all about how you manage your risk. If you can get this part right, pretty much everything else just falls into place.
So, where do we start?
Well, before we can build a system that actually works, we need a common language. We need a way to measure every single move we make with total, absolute consistency. And that language is built around one letter, R. This is probably the single most important concept we're going to talk about. R is just the amount of money you are willing to lose on any one trade. So if your stop loss is set at a $10 loss, then 1 R for you is $10. A $20 win, that's a 2 R win. A $10 loss is just a -1 R loss. It really is that simple. Now here's why this is such a game changer. Thinking in pips or dollars, it's messy. A 10-pip move in one currency is totally different from another. Plus, it keeps you emotionally handcuffed to the money. But R standardizes everything. A 1 R loss is a 1 R loss, period. It doesn't matter if you're trading gold or euros. It turns trading into a game of units, which makes everything objective and way, way easier to track your actual performance. Okay, so we've got our language down. Now it's time to build the fortress around our trading capital. And let me be clear, these are not suggestions or guidelines. These are the non-negotiable, ironclad rules you have to live by before you even think about clicking that buy or sell button. These are the absolute building blocks. First, your risk per trade is tiny. We're talking a fraction of a % of your account. This means no single trade can ever blow you up. Second, you always use a hard stop loss that's on your broker server, not just some line in your head. Third, and this is a big one, you never, ever average down. If the idea is wrong, you take your -1 R loss and you move on. Targets are usually pretty modest, somewhere between 0.7 and 1.5 R. And finally, the time stop. This is so critical. If a trade just isn't moving in your favor after a few minutes, you just get out. But rules for individual trades aren't enough. You also need guardrails for your entire session to prevent a death by 1,000 cuts. The second you hit your max daily loss, you're done. Shut it down for the day. No exceptions. Lose 3 trades in a row, you get up and take a mandatory break. And you never have too much risk open on the table at once. These rules are designed to stop an emotional spiral dead in its tracks. All right, so our rules for trades and sessions are locked in. But now we need filters. We need a way to decide if we should even be trading in the first place. You know, these are what protect you from bad market conditions where even the best strategy is going to fail.
Your very first filter is the simplest one, cost. The spread is literally the price you pay just to get into a trade. And if that price is too high, like you see in these examples, your potential profit is already gone. So before you even look at a setup, you check the spread. If it's above your limit, you just don't trade. It's a simple, binary, go or no-go decision.
Then you've got your real-time checks. Are your orders getting filled at worse prices than you expected? That's slippage. If it happens twice in a row, you pause. Is your internet connection lagging? That's latency. You pause. Is there a huge news event about to drop? You stay out of the market. These filters protect your edge from getting eaten away by things that are totally out of your control. Okay, but what happens when things just go completely haywire? You know, when the market suddenly becomes pure chaos. For that exact moment, you need a pre-planned, zero-emotion emergency protocol. Seriously, think about it for a second. What conditions would be so crazy, so far outside the norm, that your only logical move is to just abandon all your plans and protect your capital, no matter what? In those moments, the answer is simple, and it is absolute. You hit the kill switch. You flatten all your positions. No hesitation, no second guessing. You just get out, period. And these are the objective triggers. Notice there's nothing here about fear or a bad feeling. This is all data. Spreads explode to double their normal size. You get hit with slippage twice in a row. your platform freezes, or some massive, unexpected news story breaks. If any of these happen, you flatten. Your only job in that moment is capital preservation. Now, after you hit the kill switch or take a big hit, you can't just jump right back in. You have to follow a recovery protocol. First, you reset, take a break, step away. Second, you reduce your size by a lot. This takes the pressure off. Third, you review what happened. Was it your mistake or just the market being the market? And finally, you only resume your normal size after you've proven you can execute cleanly again. And all of this brings us to the final piece of the puzzle. Learning to see your trading not as a series of one-off bets, but as a statistical business, just like a casino. This right here, this is the formula for positive expectancy. It's exactly how a casino guarantees it'll make money over the long run, and it's how a pro trader measures their edge. All it does is calculate your average profit per trade, over hundreds of trades, factoring in everything. If this number is positive, even by a little bit, you have a winning system. And here's what that often looks like in the real world. Your gross edge, before costs, might look pretty good. But then you have to subtract all those costs, the spreads, the commissions, the slippage, and what's left over, your net edge, can be razor thin. This is exactly why all those rules about minimizing costs are so important. Yeah, a net edge of plus 0.07 R. It looks tiny, right? It means for every single dollar you risk, you're making, on average, just 7 cents. But here's the secret. The entire point of this professional rulebook is that you can repeat this tiny edge over and over and over again flawlessly. That is how you build a real scalable cash flow. And that's really what it all boils down to. All of these rules, these filters, these protocols, they aren't just things to help you play the game better. They are the game. Following your system with unwavering discipline is the only thing that separates the pros from the amateurs. So the final thought I want to leave you with is this. This entire framework isn't really just about trading. It's a model for making smart decisions when things are uncertain. It's about controlling what you can actually control, your process, your rules, your own discipline, so you can survive the things that you can't. So ask yourself, in any high-stakes area of your life, do you have a rule book for your risks?